Hello, it's Mark Albert. Thank you for being with me today. Today we're going to talk about the Bank of Canada and the interest rate hike announcement they made yesterday. And at the end of this video, we're going to look at how that impacts your monthly mortgage payments. And so, no surprise, yesterday they increased the rate by 0.25%. So prior to yesterday, the interest rate, the benchmark rate for the Bank of Canada was 1.5%. 0.25% higher was the announcement. So now it's 1.75%. And so the Bank of Canada, they've increased the rate 5 times in the last year and a half. So 5 times since the summer of 2017. And so there's a bit of a pattern here, and many people feel that they're going to increase it some more. So we'll see how that goes. If you like these updates on the Bank of Canada, please subscribe, and then that way you get future updates as well. So this is the highest it's been since about 10 years ago, December 2008. If you recall, into December we went into a deep dive recession, and it carried over into 2009. So 2008, 2009, really deep recession. And so prior to that recession, interest rates were a fair bit higher than they are now, but then the Bank of Canada, in response to the decline in the economy, they kept lowering the rate back then to try to stimulate the economy. And so a year ago, 10 years ago, it was the same rate that it is right now. And so why did they increase the rate anyway? Well, there are some reasons. I'm going to share them as I understand them from the research I did. They feel the Canadian economy is growing. They like the fact that Canada, the US, and Mexico all worked a deal. They revamped their NAFTA agreement. They feel optimistic about that in terms of the impact on the Canadian economy. And that was a big there. GDP growth, it's in good shape. They feel good about where GDP is at. They're expecting household spending to increase at a healthy rate. What is a healthy rate? I'm not sure, but they feel really good about it. So household spending is important. So consumer spending really drives the economy. So when consumers are worried about the economy and their job security and stuff like that, they pull back on spending. So, but right now, it seems to be an optimistic view in the economy in Canada by the average consumer, because they feel good with where spending is going to be. And also, the reason they did it is to prevent the economy from overheating and creating inflation pressure down the road. So, if you remember in the 1970s, 1980s, inflation was fairly aggressive, and sometimes it was double-digit growth interest rates. And so what happened is we got into 1991, and then they decided that they were going to do what they call an inflationary control target, where they were going to try to keep inflation between 1% and 3%. And so they were able to, they manipulate the interest rates to try to either stimulate or kind of suppress the economy. And so right now, they're putting it up so that inflation doesn't get a little bit out of control. Because if the cost of living gets out of control, then it's hard for the average person to keep up with the cost of living. So they're trying to help us like that. So let's look at a situation. If someone had a mortgage of $500,000, 25 years amortization, 5-year fixed rate, and let's say they got it a couple days ago, just before the interest rate increase, and let's say they got it at 3.6%. They would pay $25.22 a month, about there. So 2 days later, the interest rates have gone up 0.25%. So that's 0.25% higher at 3.85%. So they'd be paying $25.89, which is $67 more a month. $67 more a month is $804 more a year. So the question you'd have is, if you're renewing soon a 5-year fixed rate, you obviously got a much better rate 5 years ago, and so now you're renewing at a much higher rate. It's going to be a lot more than 0.25%. But if you delayed buying your house prior to the last few days and you're going to buy it now, just know that you're going to spend a little bit more. So just make sure your spending is in order to accommodate that. Also, if you have a variable rate mortgage, so let's say you've got a line of credit, so that a HELOC, home equity line of credit, your rate was probably somewhere around, let's say, 4.2%. And so with a 0.25% up, it's going to be 4.45%. So just know that your interest payments due on those are going to be a little bit higher, and just be prepared for that. Listen, really appreciate you being with me. Have yourself a great day, and I look forward to giving you another update on what the Bank of Canada is doing next time around. Take care.